Greetings, everyone. Welcome to this week's Macro Measure. It's Wayne back at the helm. This time around, it's October 2nd, 2022. A little bit here in front of noon here on the East Coast. Ryan, my partner, has been covering this for me the past few weeks due to road travel that was pretty extensive and got me to my destination very late. So I appreciate that from Ryan, and we'll get into it now. Let's just flash, if it allows me. Let's flash the old disclaimer, and then we will flash our intellectual property rights notice, and then we can begin to move on things. I think will let me do that. All right, so yeah, so I'm actually going to start out here on, let me make sure this has got the right record going. It seems like it does. Move this over to here. But we're going to start out really with Twitter, because you'll see why when we get into this. I had a little bit of a recording issue, so I'm hoping that's behind me and I'm really going at take two here. But so I might be a little bit more, I guess, accelerated than usual on what I'm trying to cover, just because I'm getting a little bit more pressed for time. But as we all know, right, let's just put ourselves into the right frame of mind in terms of where are we. That's always, where am I? That's my first question all the time when it comes to a trade or appreciating the risk right now, appreciating the reward. And right now, as a lot of us know, this was one of the very worst years, 3 consecutive quarters, even Market Rebellion, good old Market Rebellion Twitter got that out there. 3 straight quarterly declines for the first time since 2015. Don't see that, that often. So obviously it's been about 7 years since the last time. And I think we're on pace at this point for one of the very worst years since the 1930s, maybe 37, I want to say 32. Can't remember which of those, but point is that it's really been rough. And of course, the big question on everyone's mind is we're about to start Q4, and where do we go from here? And so where we go from here is really a tough one, I think. And I think it's really more about the conditions right now, because I think you can argue both sides and you could probably make a pretty good argument on either side, really, because on the negative side, right, why do things continue to get worse? Well, a lot of you may know that my basic take on things this year has been, if rates are going higher and the economy is so rate dependent, especially housing, which is really probably the most important driver of the US economy, at least it has been in, say, the last 20 years overall, then, right, with other big ticket items along with autos and so on and so forth, with that being so rate dependent, prices being so high, and folks their wages not keeping pace with all of that in terms of rates and inflation, how does the economy keep going? And of course, this is really a big deal. When people were getting such incredible rates not too long ago, we're now above 7%. So that's pretty bad. Now, just a little quick sidebar, as things are burning, our wonderful obtuse Fed, or intentionally obtuse Fed, is more focused apparently right now on climate finance, which I have no words for that. And they're following the Chinese Communist Party's social credit score system in terms of this new thing that they're rolling out. So ESG compliant monetary network. It's hard to believe that you could become even more obtuse, but that's what's happening right now. So I'm not sure there's a lot of faith, right, in the Fed, especially with this type of stuff being on the docket, so to speak, whereas they've managed to screw things up royally with respect to interest rates, and really rigging the stock market for the last, I guess, really, I guess about 12 years plus, maybe 13 years. But that's what's happening. As a lot of us know, they've got this emergency meeting that wasn't scheduled, set for Monday morning. And so that really does, again, potentially blow the charts out of the water, so to speak, because we could sit here and chart for hours and contemplate this, that, and the other thing. But if there really is some news that comes forward from that meeting, that would be something that could trump anything, right? It could exacerbate the situation. It could help bring about a strong reversal, at least a short-term tradable relief rally squeeze type of situation, which we've seen several of this year, but there's such a big problem. They have such a big problem on their hands. If you look at this, as they're noting, right, the Fed is always late and then it overreacts. And of course, that's very true, at least in my opinion, it is. And another good point that someone else made down here is that, right, the Fed's barely gotten started in terms of the balance sheet reductions that are planned. So this is just getting started, and you can see the turmoil that we're in right now. So we're really in quite a pickle. The Fed isn't the only one in quite a pickle, right? The federal government, the way that it's been, I guess you would say, mismanaged their affairs anyway, right? We are so deep in debt that it's starting to get quite vertical, as our old friend Sven notes here, in terms of the interest payments, right? What it's going to be required to continue to carry all the debt that this country carries. So this is kind of arguing more on these tweets are arguing more on the side that things continue to get worse. And then we'll see some things that maybe say, well, maybe not so fast. But this, to me, is the bigger deal right now. Not all of these are incredibly timely, but it's just some good things to keep in mind. In terms of short-term trading, what does or doesn't come out of the Fed is likely to be at least a, excuse me, a temporary driver, which we'll talk about, excuse me. But the charts are, this is really supposed to be about the technicals more so than anything, but the charts are, you'll see the charts are really just about all in the same place. It's hard to really, given what we know could happen, it's hard to really get very full of conviction on the charts right now, in my opinion anyway. But anyway, this is another one, right, with baby boom generation. There's been some incredible declines. We've seen incredible declines where the market's lost half, if not more, of its value in about the last 22 years. That was the old tech boom, internet boom bust, whatever you want to call it. That was probably the worst, especially for NASDAQ stocks. But then after that, we had a couple other doozies as well. And excuse me, we're in the midst of one right now. So this is a great question, right? I mean, at what point do you worry about everything that you built up if this keeps going down? If you're a boomer and you're really running out of time in terms of your investment time horizon, you really can't afford to take a real beating, towards the tail end of your strong investing days. This is, everyone's probably heard of this, that there's rumors flying around that credit stress is becoming a big deal. Some people are thinking, there's been rumors out there that either Deutsche or Credit Suisse could be about to implode. And you know how that contagion often spreads. Our own Rebel Pit Crew member, Z-Red, put this out there for us. And this is a nice little graphic. You can see, right, where the S&P 500 is in terms of the EPS, on 5-year EPS right now. And you can see, right, the date of the bear market low and where other ones have bottomed out. And of course, even if you take the most aggressive one, which is the COVID situation, you still have a way to go in terms of falling. So again, this is really more of the argument, well, that despite everything, excuse me, there's a lot of reasons why you could keep falling. Don't know what happened to my graphic on that one. Excuse me. That one's, maybe I misclicked, but we'll just skip over that. No big deal. There's plenty of other stuff. Another negative would be, right, the current sentiment, which is represented here, versus the positioning. And you can see there's a pretty strong correlation. It looks to me, right, that sentiment tends to lead positioning. But if sentiment stays as bad as it is right now, right, what does that mean for positioning? It's not boding well, right? There could be even more selling. Now, remember that the seasonality factor, which we'll talk about soon, that tends to be, right, well, that's right here. So here's your old, right, September is typically pretty awful. These are stock market monthly returns since 1896. You can see this is probably your strongest 3 months in a row for the market, is right in here. So we're coming into that. So can we get that despite everything? And once we see the rest of these tweets, we'll have a good sense. But this is still really on the negative side. If you come back here and look at the Buffett indicator, and here's your Buffett indicator in blue, And here's, this would be fairly valued in here. You can see where we still are based off of the Buffett indicator, if you want to put any weight in the Buffett indicator. So there's a lot of things like this that will tell you that, no, you still have a ways to go. Let's see on this one here, total market return with valuations. Okay, so again, you can see that we're up there. We're really, really up there. And some of these other levels, right, these would be far, far below where we are right now. Let's see if there's one more little thing we can pull out of here. Let's see what this one is. Oh, okay. So yeah, so this was kind of the Druckenmiller argument of here's Druckenmiller noting that given where we are in the grand scheme of so many things, he's wondering, excuse me, if you even get positive returns over the next 3 to 5 years in the market, that it literally might take that long for this thing to really recover from what it's been through, thanks to these really, I don't know, intentionally obtuse central planners. Now, here's where we would start to argue for what happens right from here. And you're down at essentially 0 or 1% in terms of sentiment. And as many of you know, right, sentiment is contrarian, right? It can be contrarian. It's usually looked at that way. When everyone's bullish, get a little worried. When everyone's bearish, right, get ready to take some action. But I think that's what I think this is all about. It's really about buckle up time. We have an election that's coming up. We've got the end of the year. We've got some other things that are just remarkable, which we'll see shortly, but that just argue that you could get a rally that's incredible if they're able to pull it off, right? And that's the thing. I don't know if something's going to break and that's going to cause even more selling. And then, excuse me, a lot of the things, excuse me, that we normally would look at really won't work as they normally do, which we'll talk about. But yeah, I mean, this is how poor sentiment appears to be, at least on the measure they're citing there. Here's SPAN again, and you can see that this is one of the very worst readings we've seen for many years, and actually is the worst reading we've seen in many years. So you've got fewest components above in the S&P 500 above the 50 SMA. So that, or 50 MA, I guess, which is really the SMA. So that gives you an idea how bombed out, right, this is. That's the phrase a lot of folks have been using. I think it's a good way to quickly describe it. We've been talking about this throughout the year, and the CTAs continue to cut their exposure. Commodity trading advisors, they're the most short equities. These, to me, this gang, I don't know how they've been having a good year. Some people are claiming they are. It seems like every time I turn around, they're super short at the tradable lows, and they get very long once the downtrend's about to resume. But again, this would be more contrarian in my mind, that they're now very, very short, extreme in the extreme. So that's or at least the recent extremes, right? So that's kind of an argument for a bounce right there. Again, we're kind of in that territory. And then here's another one where you're getting, you could see just in terms of another view, right, that you're very oversold already. So just a quick way to look at it. You can look at the Williams percent R. There's a lot of things you can look at. I'm not a big percent R person, but there's nothing wrong with it. I'm just saying, like, I just don't use it that often, but there is persistency of overbought and oversold. But yeah, you're starting to get down there. And then even using our own tool that taps into TradingView, I'll try to show these really quickly, so then we'll move into the charts. But here's the percentage of stocks that are above the 200 a day moving average. And you can see that we are down near some of the lowest lows, maybe not at the lowest lows, but you're darn close. Now, if we keep going here, let me see if I can get the others to show up here. Here, this is going to appear across the board. Here you are above, with stocks below, I should say above the 50 SMA. And there you can see we're near the very lowest lows with what happened last week. And then finally, we'll do MMTW, which is the stocks above the 20. And you can see that just these are near what were at least short-term tradable lows before. So that's where we are across the board. We're really, 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 as I've been saying, bombed out. Others have been saying just really bombed out. And so we have the summary on, I think, on this section of this video would be, we have major problems for sure going forward. We might even have major problems that intensify in the short run as well. We just don't know. It certainly could happen that way. But if we start looking at the charts, let's see if I can, and we are where I want to be for a change, that's good. But if I just go through here, we'll start out with a simple spiders chart. And I want everyone to look down here at my RSI reading, but here you are on your RSI, and you can see this was a pretty rough day. Look at that volume that came in. So maybe, right, this is the start of the volume pickup that's really about to deliver that capitulatory phase that we've been, that phrase or that term that we've been using. But you're at 27 on the daily. Now, I'll give us a little more time. I'm going to say that this volume, we haven't seen volume like that since near the June lows. So that's pretty big volume, but you'll notice, this is what I'm talking about. Notice this volume profile right here. This is what I'm thinking we're going to see something like if we finally do get the capitulatory phase, where it just gets super ugly and volume builds and you get this sort of crescendo of selling, and then it kind of peters out, and then they try to put something together, because they always try to put something together to get things levitated back up. But note, right, if we look at this view, it's very clear that, excuse me, we're outside of the Bollinger Band of the downside. So that green dotted and red dotted area, those are my Bollinger Bands. They're set off the 100 SMA as the spine in here. I think it's the SMA, it could be EMA, can't recall which one I'm on. The point is, though, I don't really use this for active trading or decisions like that. But what I do like to note is that when there has been an excursion, they usually don't last that long. You can come back to here, right? They clean it up pretty quickly when you get beyond your Bollinger Bands. It could take a little while, of course, not in every case, but they smack it all the way down. You finally find a low, and they bring it back in. A couple of days here, they bring it back in. You get the idea. So that's why this is tough. But on this view, right, you're at 27 on RSI in the lower left corner. If we go to weekly, excuse me, excuse me, you're right at a critical level in terms of, you're right near your downside Bollinger, excuse me, you're 35 on the RSI, and you're right below the 200 week moving average in this case. So this has really been a very, very powerful sell-off ever since we topped out about 3 weeks ago. You're just not quite there yet. Now, there are no, of course, there are no rules that stipulate that we have to get even more oversold. But what I'm thinking is, going back to this would probably be my most favored scenario, most likely scenario. I think the Fed is the wild card, unfortunately. If it weren't for the Fed, I'd feel a little bit better about this. I would feel as though they're going to hit this a little bit more, bring this down to another, let's say a little bit of a lower level, maybe something like 350 for starters, right around, let's get it close to there, right around there, 350. And then I would think that then you'd have another attempt, if it does find support there, to then start to bounce back up, get inside the Bollingers. And then what we'd probably have to look for would be something like this. See if I can get this drawn okay for us. We'd have to probably go with something like that if it does drop, to see if it can at least start breaking through there and then back up. But that's kind of getting ahead of ourselves. I think without the Fed, I think there'd be this, at least a little bit more selling that would result in maybe some capitulation for this phase of where we are, for this selling wave of where we are. But again, I have no idea what the Fed's going to do on Monday, right? They have had a meeting before that was between scheduled meetings. I think earlier this year they did that. I don't think anything came of it. So I don't know if this has been precipitated by the Bank of England, the concerns about what financial institution could be on the ropes and may need to be effectively mopped up, so to speak. Could be. I mean, of course, I'm just speculating, but I've seen some things out there on Twitter, some of my own thoughts. I'm thinking they're worried about systemic things because of maybe some European financial institutions. That's just a guess, though, just a guess. So no real research or any particular story that I've seen that had a lot of concreteness to it. But that would be it. And the reason why this is such sort of like a short video that's not really long on technicals is because, as all of you know, I mean, even if you're new to all this stuff, you know that here's a 26 reading on the diamonds. You know, this is where you are. You're way out of your Bollinger Bands. I could probably play with a setting here. Let's see if I can just grab those and edit those studies. Let's see if I can get it to maybe like 2.5. I don't know if it'll get that far, but yeah, it's your 2.5 standard deviations removed from the 100 SMA, your long-term mean, and that's a pretty stretch move. You don't even, it's been a severe year for stocks, but you don't normally stay beyond that, as you can see, for very long. So I think we're getting closer to the end of this, but again, I have to always have that caveat of I don't know what the Fed may or may not do. I don't know if the Fed just has the meeting, and then the fact that they don't step in really brings about even more selling, because all of these bulls that have been conditioned to think that the Fed will always save you, they may have to finally face the reality that it's different this time. I don't know. I can honestly see the Fed basically have the Fed's bluff being called by the markets and the Fed capitulating again, because the Fed really does nothing but keep this incredible Ponzi scheme going. It would be a real departure for the Fed to not keep the Ponzi scheme going, because that's what they've been doing. But there are some gaps in here. If it does get really ugly, right, that's when I start paying attention to gaps. When this is why the oversold conditions, may not matter. When you get to that final phase, it doesn't really matter. In fact, let's come back and look here on that particular day, and you got to 18 on the RSI and the diamonds, and that's exceptionally low. So could you see that again when you get this real kind of panic capitulatory phase on? For sure. And then that's just what happened. That's when the oversoldness and all these market breadth things that say we're bombed out. There are times, they're probably rare relative to when oversoldness and other market breadth indicators are registering the old bombed out readings, and you probably normally get bounces. But when you're in the middle of what could be a crisis, that's a different story. So that's why this upcoming week may not be easy. I think you would just call it, if you put a title on it, just call it buckle up. I can honestly see dramatic changes in either direction, but we haven't seen this kind of a panic phase kick in yet, despite the fact that we are at 33 on the weekly in terms of your RSI, and you're already at 27 if we round it up there. Now, the other ones would be naturally IWM and the Qs, which we'll take a look at. But IWM, was kind of had an ugly candle there on Friday, and it had some pretty serious volume start to pick up, but it also was able to hold. And it can do that. It can be a little bit sticky at times and act a little independently, since they're treating that part of the market with the small caps a little bit differently than the large caps, mega caps, et cetera. But you can see this is right on the lows. Still, right, even with holding up, it's still at 32 on the daily. So is it close enough to be considered oversold in my book? Yes, but I certainly do think that if we do get the most likely scenario, we just get a little bit more weakness. It creates maybe more of a cathartic sell-off with some volume spikes. You have to really, unless there's a crisis that's unfolding in the news, you probably have to expect a rally in the absence of news. If the news is really the driver, then that there's something that's getting really broken apart or about to fail, and it's causing systemic risk and the system seizing up, all those types of things that you hear, then it's a different story. You might get that really, really serious capitulatory phase. If not, I would say they sell them off a little bit more probably, and then maybe try to put a rally together. Then we'll see what happens. Certainly the seasonality we know favors them trying to rally. And I would think that I don't think that with the midterms coming up that the powers that be really want things to be careening lower, spiraling even lower than they already are. So there's a lot of things that go on, and every administration, I think, leaves their fingerprints on things. So it's not a party thing at all. But IWM, excuse me, approaching there on daily, and then on weekly it's at 37. So not quite below 35 yet, has room to go, and it would come into plenty of flat line-ish support, so on and so forth over here. So I do think again, to reiterate, I think that you probably get the little bit more selling at the very least, and then we see what happens in the news cycle, and that would probably determine the magnitude of what's going to happen here. Remember, do not let your guard down. Falling below the 200-week moving average, as the Qs did, as some of the other major index ETFs did, that's a great way to get people that are looking at bigger picture charts, as I like to call them, more panicked, right? Remember that false breakouts and false breakdowns, whatever you want to call those, head fakes, whatever, those are also great things to look out for trades. So don't sleep on any risk, long or short side risk at all this week, because again, these guys are incredible at what they do, and you just can't rule things out. But here we are, weekly 35 RSI on the Qs, and then daily is, I think, pretty ugly with what happened here. And you're at 28, so you're already below 30. You're getting close to, of course, you made a new low, and you're getting close to your lower Bollinger Band, which again, we have now set at negative 2.5. If I flip that back, I think you're there. So let's see where we are just on regular 2.0 settings. Yeah, you're right there. So that's pretty extended. Now, granted, the bands are more on the narrow side here, so it's not the biggest deal. I look at when I see really wide bands, kind of like back in here, versus these narrow bands, then the excursions mean more to me that way. So I'm not really thinking this is anything quite dramatic yet, but it is there on its face, and you're at 28 on the RSI. So not you can't say, well, no, you're not oversold. You are. It's just that this phase keeps eluding us. I added. I feel like I added so many bears in UOA Pro this week to have folks ready to trade different things. We've had a lot of bears, of course, really all year, and we've tried to keep it loaded up. But I've been sensing that there's this capitulatory phase seems to be getting closer and closer, where they just can't sustain a rally for more than a few hours, maybe a day. And when you're starting to really see such poor breadth readings, it usually means that you should be close to when you have no positive action and you have awful breadth, that should lead to that phase if they're going to deliver one. But it's eluded us, right? Those ideas have not, a lot of them didn't even trigger, because we just didn't get that final really, really ugly phase. Let me bring up a few other things here. And let me just move this over here so I can get a better view. What I wanted to do to kind of wrap things up is note that note where SMH is, right? This is a really important sector. Again, if you ask me, you could see that's really been crushed. New low for the year. Current RSI 28. What about your weekly RSI? It's 34, and you're just about to lose the 200 week there in purple. You're on the lower Bollinger Band there, even on the weekly. Again, bands are on the narrow side, so not the biggest deal. But if you do get through here, you're probably looking at somewhere down another 10%. I would ballpark it at, roughly speaking, where you hit the midst of all this sort of support back over here. So, and that really wouldn't be it. I don't know if you get it right away, though, because of how extended everything is to the downside. That's that really is the big question this week, is that you're already so rough. Do you finally get the capitulatory phase because the Fed meeting comes and goes, and all the hopes that maybe created in the short run are dashed, and then we finally see that that capitulation? Don't know, just throwing it out there. But that's obviously the SMH looks terrible, and it's coming into the 61.8 retrace here from this whole move. So the post-COVID bounce move. So where do you go right from there? I think I really do. I think you crack here. I do think you're dropping down into that one. I'll call it the high 160s to 170. So like I said, about 10% more. And a lot of those stocks we've continued to add put spreads or put ideas in some of those big names. We've had all the big names really in NVIDIA, AMD, Intel, SMH itself. We've had a lot of things in there, but that looks really rough. By the same token, right? You could argue, well, no, it's due to bounce, right? Look how oversold it is. I can't argue with that, but I also can't argue with the fact that this capitulation phase would seemingly be approaching in my mind. It just seems like it's getting there. We'll find out if it's going to come. Very interesting. I expect this to be an incredible fourth quarter with what I'm seeing. And also, right, let's note, since we're talking macro measure stuff here, let's note that the dollar had this amazing run. We talked about this eventually having another pop, and it actually did deliver it last week and the week before, really gunned up there. And now it's coming back to a more, let's say, normalized level. So this got, you can see up in here, let's get to this day right here. You're at 79, just an amazing overbought reading there in the dollar. But this is coming off now. And every time we've seen, right, these really strong spikes, there has been a little bit more time where it's sort of backed up and filled a little. We've even seen it come back to that 50 there in gold several times. So that would be helpful. If that continues, that would be helpful to the market. So I would put that 20 SMA there in blue as a big one to watch, that if it can't hold above there, it's really close to the support line that I've got drawn there. And if that doesn't hold, then you might come all the way back to 50. If you do, that would seemingly open up some breathing room for the markets to put a little something together. The yield, the 10-year yield too, this one's very extended. You can see that, right? That got up to 82 on your RSI reading right there. Of course, that was extreme. And I think if I give you a bigger views on both of these, right, that you're at 74, my gosh, on the weekly. And if we go back to the dollar, it probably really got up there on its high too. And we can't really get the highest high, but it's at 72 now after backing off that much. So that gives you an idea. So I think those are telling you that there's a chance here at a rally, because those are backing off. And the final thing I think I'll note to wrap this up is that the VIX, and we'll go back to the daily view on this, but the VIX was interestingly subdued, I thought, on Friday. Someone pointed this out in Rebel Pit. I was always keep an eye on it, and I was noticing it, but I did make a comment on that, and I made a comment on Cocktail Hour as well, because that did I was surprised by that. I just thought that this maybe the VIX is just getting a little bit more dialed in, and folks are realizing that we're so oversold that in most cases you'd see some sort of a bounce attempt here. I don't know. It's hard to say like on one day's action, but so bombed out, so many things really overdone that have been bearish drivers. Dollar, TNX, for example, VIX subdued. Maybe that Monday morning thing, maybe someone knew, maybe the Fed is going to do something. I don't know maybe they'll come out with assurances. I don't know. Maybe they'll say nothing. That would seem to be the big early part of the week thing we have to get through to know our fate, right? What this means. And the way I don't know, I guess hope may still be springing eternal for the bulls that think the Fed should come out, and the Fed's bluff will be called, and they'll finally come out and cry uncle and say, yeah, we're going to support this or that because we're just getting worried about the system or whatnot. And just remember, even if it doesn't make sense, even if it's nothing special, these guys are incredible at getting a remarkable rally put together on a shoestring budget of virtually nothing, right? So when you're this oversold, the slightest whiff of anything they can string some bullish story together to get the talking heads on TV to bandy for a few weeks, they'll do it. Again, not predicting that, just saying. So that's the way I've seen it in my career, where they'll try to attack people that have a problem with what's happening and calling things reckless that are reckless. They'll have a problem with that on television. Meanwhile, anybody that shows up with a bullish story, they're all too willing to help sell. And anytime the Fed does anything dovish, they're all too willing to help sell. But that's really what ultimately led us to the brink of whatever we're at right now, unfortunately. So we seem to be paying the price now that we should have paid in a much smaller way many years ago. But with that, I don't think there's much more I can add. You know the situation. It's very right. It's very oversold. There's a lot of other things we could even bring to bear. There's good arguments to say it doesn't matter. You just keep going. Things are going to intensify, but there's also contrarian stuff out there and the seasonality and things like that would say, look, you probably do get a rally soon because it's not normal. If it's not normal, so if you don't fall, it's interesting in the fact that if you fall apart completely, you probably get a rally. If you don't fall apart completely, after they take it down a little bit more here and there, could be one final flurry of selling. They probably will try to put something decent together just based on where we are in terms of oversoldness and the fact that we're outside of Bollinger Bands and things are just so dismal already, absolutely dismal already. So hang in there, be smart with playing defense, be nimble. If you've gotten through the year with what we've said so far, you've done a great job. Remember, a lot of people didn't take action, unfortunately, and didn't play defense, and they're seeing the other side of risk, unfortunately now. But hopefully this will turn into a market that's not all down soon. I think it would be nice if we could get a little bit of a tradable bounce here at the very least to work with, because I do think if they do get us into that relief phase, I do think some of these things have been so punished that they'll deliver really strong bounce moves that we can hopefully catch some of and put a little bit more in the kitty in terms of some bullish tradable bounce trades. And I guess that's the wrap. From here, I'm going to embark on the old sector situation, which is another kind of boring exercise this week, but it is what it is. So everyone take care, stay nimble out there. We'll see you in the webinars. We'll see you in this week's ideas, updates, so on and so forth. Thanks for tuning in.